Hello my friends, my name is Sandra. Welcome back to my channel. Today I'd like to talk about what we should be doing as retail investors now that emerging markets have been falling. If you have been looking at emerging markets, or if you own emerging markets as part of your portfolio, you would have noticed that they have been falling recently. And why is this the case? It's because there are a few factors. One of them is a burnout for tech and AI. Recently, there have been reports of many companies spending a huge proportion on tech and AI, and doubts related to this spending has triggered a sell-off in some of these stocks. And because the emerging market index is heavily concentrated on some of these tech giants such as Samsung, so a drop in their share price also sees a drop in the emerging market index overall. In addition, markets like South Korea have been heavily leveraged for a while for their investing in their tech giants as well as their ETF trading. So when a sell-off occurs, these investors, they get margin called and they are forced to sell off, and this causes even further drop in the stock price and the entire asset in general. So what we should be doing now that emerging markets have been falling? Number one, ask yourself, does emerging markets still deserve a place in my portfolio? If your answer is yes, then the short answer is don't do anything. Or another answer is continue buying. If your answer is no, emerging markets do not belong in my portfolio anymore, then you should decide to slowly sell it off. But this selling off should be due to your investment thesis changing and not because the price has fallen. Second, you ask yourself, are you a short-term investor or a long-term investor? Long-term investor means you are still in the market for the next 10, 20, 30 years. If you ask yourself, in the next 10, 20, 30 years, do I see emerging markets like China, South Korea and Taiwan still continue to perform? If your answer is yes, then you should continue to be in emerging markets and continue to buy emerging markets. If you're a long-term investor, you should know of the dollar cost averaging approach. Dollar cost averaging means every month you allocate a certain amount to the stock market to buy certain stocks or ETFs that you believe in. And every month, whether the stock is low, whether the stock is high, whatever news is happening, you continue to buy. And that's if the stock has strong fundamentals. In the long term, the stock market has shown to continue increase. So whether you buy low or you buy high, in the long term, your portfolio will continue to grow. However, if you do emotional investing means you're happy when the stock is high, you buy at all-time high because the hype around the stock is very great, you believe it will continue to grow up, and you buy at a high point, whereas for whatever reason the sentiment goes down, the stock continues to go down, you get scared, you sell, and that's when you sell at a low price. So you buy high, sell low, and that's when your portfolio will not perform well in the long term. So as a retail investor, the best way you can do is to invest using numbers instead of using your emotion. So what do I mean by investing using numbers? You look at your portfolio. If you believe that emerging markets should consist of about 10 to 15% of your portfolio, after the recent drop, the emerging markets now form about 8% of your portfolio. So what you should do in the next few months is to direct more of your investment to emerging markets so that it can form closer to 10 to 15% of your portfolio instead. And that's what you call investing, smart investing using numbers instead of using your emotions. So in conclusion, emerging markets, they are volatile in nature. They frequently underperform the rest of the markets before outperforming them. And at which point of time it goes down, which point of time it goes up, no one will know. If someone claims to know that it will either go up or down in the short term, they are most likely lying to you. Even financial gurus like Charlie Munger does not know the exact point where it will go up or go down in the short term. So if you have strong belief in the fundamentals of a stock or in the market index in general, then you should continue to invest in a dollar cost averaging approach every month as a retail investor. Okay, that's it. Thank you. Remember to like, share and subscribe.